Hey guys, welcome back to Yogic Investment. Today I'm going to discuss one of the legendary investors, Warren Buffett's advice on making an investment. Make sure to stay till the end of the video to fully understand this advice, which will be pivotal in your own investment decisions. Be sure to subscribe and turn on the notification bell to check out our future videos, as we will be soon uploading regular quote analysis. Okay, so from a mere $100 investment in 1956, Buffett has amassed a wealth of over $80 billion to this date. Along with his daily few hours long reading sessions, Buffett has combined his learned knowledge from a few of the best investors of all time, Phil Fisher and Ben Graham, to generate an annual average return on investment or ROI of over 20% since 1965. So how can we learn from him and improve your own investment strategies? Well, in this new series of quote analysis, I'm going to share my learning from studying his investment strategies along with his quotes during his prime years and hopefully transfer that knowledge over to you investors. I will create a video for each of Buffett's quotes from now onwards. Well, so being an avid value investor myself and a so-called student of Mr. Buffett, I've applied his methods and generated a significant amount of wealth, which is mostly attributed towards his 60 years of condensed wisdom. So here lies the question, why trust Mr. Buffett? Well, firstly and most importantly, he's a candid investor who shares his knowledge willingly without being driven by institutional imperative. Well, equally importantly is the significant amount of wealth he has generated for his shareholders and investors in Berkshire Hathaway, which runs as his primary institution for investment. As seen on the screen above, over the past 30 years, the price of Berkshire Hathaway has risen by approximately 4,500%, which is extraordinary. Well, let's dive into one of the best quotes by Mr. Buffett, which succinctly represents his value investment philosophy. Well, the basic ideas of investment are to look at stocks as businesses, use market fluctuations to your advantage, and seek a margin of safety. 100 years from now, they will still be the cornerstones of investing. Well, to comprehend this rather complex quote, I'll break it down into three main parts. The first key principle to digest is that a stock should be only viewed as a business, whether he buys a whole business or any other outstanding stock of the company. He views it as buying a portion of the business, not just buying a mere stock certificate. He suggests when you buy a stock, you should view it as a business rather than a certificate. Buying a business involves analyzing the underlying fundamentals of the company. Hence, he strongly believes that over a long period of time, the stock price will eventually reflect a company's revenue and profitability growth. This profitability is a result of a strong underlying business. Hence, to expect an increase in a company's share price, Buffett ensures that he first analyzes the key aspects of the business, which would entail the management structure, key partners, their products' competitiveness, and their financial position. This information is not just exclusive to Mr. Buffett only, but is available to every single person out there in the form of an annual report, slides, or even reports found under the investor relations of a company's website. An example of the share price reflecting a company's profitability is Coca-Cola's income, doubling while the share price increases as shown in the graph above. This then begs the question of how to take advantage of such market misrepresentations, which leads into my next point. Okay, so moving on, Buffett's second element in the quote is to take advantage of market fluctuations, which is completely different from trying to time the market, which should be avoided at all costs. The stock market is like a voting machine in which votes are driven by people's emotions. Well, similarly, stock prices are subject to fluctuations due to several reasons, such as emotional buying and selling by the general public, market sentiments, political or economic news, and much more. However, these changes are mostly short-term and generally reversible, which does not affect the company's long-term earnings potential. Hence, if a stock suddenly drops and is significantly below the company's intrinsic value, an investor should grab this opportunity to buy the undervalued and fantastic business. During this process, it is also important to remain emotionless and view the stock as a business. Investors then start to wonder how much of a drop is justified to buy the company at a given price. Well, hence this brings up my next point of a margin of safety. So the term margin of safety, coined by the legendary investor Ben Graham, can be simply described as the difference between the share price and the intrinsic value. Once his analysis of the company's business passes his criteria, he will then move on to calculate the intrinsic valuation of the company. During market fluctuations, if the share price drops significantly below the intrinsic valuation while exceeding or meeting his pre-decided margin of safety, Buffett would definitely buy the company. Well, an example would be his purchase of Coca-Cola stock in 1988. The market valuation was $14.8 billion at that time, while his calculated valuation was actually $48 billion. Hence, using the formula shown on the screen, this margin of safety was an astounding 224%. As one increases his minimum margin, the chances of making a loss during a crisis will be greatly reduced. However, on the flip side, the greater an investor's margin is, the less likely an investor will find an opportunity where the price is below his decided margin. The general rule of thumb is that investors with a smaller risk appetite and more time should opt for a higher margin, while people with the opposite should lean towards a smaller margin. However, one should do significant companies' fundamental research before picking the stock to invest. The aforementioned holy grail of investment rules have been the cornerstone of investment for the past 100 years, and it will not change unlike other forms of investing like day trading or forex trading. I highly suggest you investors to adapt Buffett's style of investment, since it has been proven to be the most effective and consistent over a long time frame. So this channel will focus more on uploading more informative videos to educate value investors across the whole spectrum of experience. So if we can hit 50 likes on this video, I'll ramp up the production frequency of this channel. So I hope you, my fellow investors, have learned something new and applied this along your own investment journey. To reach out to a larger audience and help more people struggling to generate good returns, please like and subscribe and turn on the notification bell to stay up to date with new videos. Have a nice day and I'll see you all soon.